Welcome to part 3 of this series, Unpacking the World of Hedge Funds. We will look at why are hedge funds different. Today, we will talk about hedge funds over a cup of coffee. We will take a peek at the investment menu and explain why hedge funds are flexible. Let's begin and grab that cup of coffee. Today's opening question is straightforward. Would you rather have a cup of instant coffee or barista-style coffee? I know of many people who would rather skip their morning coffee instead of having instant coffee, and they organize their social lives around coffee shops. How about you? Would you rather have instant coffee, or do you appreciate a fine cup of coffee? We ask the very same question to investors. Would you like to invest in unit trusts only, or would you prefer something special, like including hedge funds in your investment portfolio to add more flavor? Investing in traditional unit trusts can be compared to mixing instant coffee and hot water and adding milk and sugar according to taste. The method cannot be modified much, leaving you with a basic cup of coffee. Unit trusts will deliver just that, providing you with a moderate or high return when conditions are right and markets are climbing. The fund managers are not allowed to employ alternative investment strategies that add that special flavor when it comes to enhancing returns, possibly even in falling markets, and positively changing the risk dynamic of the portfolio. In contrast, creating a remarkable cup of coffee requires a different approach and the touch of a barista or a high-end coffee machine. For instance, these machines have various functions and they can customize the drink's strength, size, temperature, frothiness, and even add flavors of hazelnut, vanilla, and so forth. Hedge funds are like baristas or exclusive coffee machines that provide a more flexible approach, including alternative investment opportunities and strategies that go beyond the traditional cup of coffee. Let's look at two real-life scenarios to illustrate how different portfolio constructions drive performance. In this case, we have invested $250,000 over 5 years in a retirement annuity, and there are two portfolios on the menu. So you need to decide which one you would have preferred. The first option is a cup of basic instant coffee, which means that your portfolio only consisted of a multi-asset balanced unit trust. For illustrative purposes, we have chosen the 4 most popular balanced funds, and this is how they have performed. Please note that even though we are not disclosing the names of the funds, all data is based on actual performance figures and was sourced from Morningstar. You'll see that Fund 4 has performed the best over the investment period, providing a cumulative return of over 54%, which means that the 250,000 Rand has grown to almost 390,000 Rand. How did the specialty beverages perform, blending unit trusts and hedge funds? The Regulation 28 compliant Fairtree growth portfolio that we've chosen consists of 90% of traditional unit trusts and 10% hedge funds. The cumulative performance of this portfolio over the 5 years has been more than 75%. In monetary terms, the 250,000 has grown to almost 440,000. I'm sure you'll agree that when we compare Fund 4 and the Fairtree portfolio in this case, it's clear that alternative assets provide superior returns for you as the investor. This slide provides a different angle to show the growth of the 4 funds and the portfolio including the hedge funds. You'll notice that the orange line wins by quite a large margin. This scenario follows the same trend. The only difference is that we've blended the 4 unit trusts in a portfolio with an allocation of 25% to each fund. The reason why we've done this is because retirement annuity portfolios that we often see in the industry consist of a couple of balanced funds blended together to provide some measure of diversification. This equally weighted blend has returned almost 51%, whereas the portfolio, including the hedge funds, provided a return of more than 75% over the same investment period. The difference in Rand and cent is remarkable, and imagine what the effect over 10, 20, or 30 years would be, depending on when you'd like to retire from this retirement annuity. Once again, the slide will show the growth of the 250,000 Rand, and you'll see that the orange line representing the combination of unit trusts and hedge funds has outperformed the standard approach. When you look at your current investment portfolio or when you must choose something from the investment menu in future, ask yourself, am I missing out on a world of unique flavors? In parts to follow, we will illustrate in detail how including hedge funds in various discretionary and pre- and post-retirement portfolios have benefited investors in the long run, especially during turbulent times like Nenegate, the COVID-19 pandemic, and so forth. As we have seen, hedge funds clearly operate differently. To explain their flexible nature, enabling them to do so, it is useful to compare them to other unit trusts. This table provides a high-level overview of what hedge funds can do. They can, for instance, invest in private equity and real assets. They can use gearing, use derivatives. They can do short selling. They can invest in structured products and non-traditional assets. And they can also make use of complex active management strategies and dynamic risk exposures. To gain an understanding of some of these key concepts, please watch the following videos on hedge funds, gearing, and private equity and real assets.
Let's talk about hedge funds. Hedge funds are different to unit trusts. This means that unit trusts can only make money when the price of the security that it bought goes up. If you buy something for 100 Rand and sell it at a future price of 150 Rand, you make a 50 Rand profit because the price went up. With hedge funds, you can make money if the price goes up or down. It all depends on the position the hedge fund is holding. Let's illustrate this with a cell phone example. You believe that the value of an O phone will go up in the next year. Therefore, you are wanting to buy it now for cheaper at 15,000 Rand, as you plan to sell it at a higher price in future. You also believe that the value of a Samsung will go down in the next year. Therefore, if you buy Samsung today, it would be more expensive than if you waited and rather bought it at a cheaper future price. Because you believe that the price of Samsung will go down, you decide to borrow a physical Samsung phone valued at 15,000 Rand and then sell it to someone for 15,000 Rand. Your current cell phone portfolio is now holding a physical O phone valued at 15,000 Rand and 15,000 Rand cash from selling the borrowed Samsung phone. A year goes by and your predictions were correct. The O phone is more expensive, valued at 17,000 Rand, and the Samsung phone is now cheaper at 13,000 Rand. So what does this mean for your portfolio? The O phone went up in price. You bought it for 15,000 Rand and can now sell it for 17,000 Rand. This means on this investment, you made 2,000 Rand profit. A year ago, you borrowed a physical Samsung phone and sold it for 15,000 Rand. Now, you need to give the borrowed Samsung phone back. With the Samsung price going down, you sold it for 15,000 Rand a year ago and bought it back for 13,000 Rand a year later, so that you could return the borrowed device. With Samsung's price going down, it still gave your portfolio 2,000 Rand profit, leaving your portfolio with a 4,000 Rand total profit. Hedge funds can make money if the market goes up or down. It all depends on the position the hedge fund is holding. What is gearing or leverage in hedge funds? The best way to explain gearing or leverage would be with an illustration of a lever. As one person to try and lift 1.5 tons would be difficult. Placing a lever under the load allows you to carry a heavier load with less effort. Gearing or leveraging in investments is similar to this. With traditional investments, if you invest 100 Rand, That gives you 100 Rand exposure or buy-in to the market. Gearing or leverage is using borrowed money to increase the return investors receive on an investment. If you invested 100 Rand into a hedge fund that is 3 times geared, your 100 Rand would be 300 Rand exposure or buy-in in the market. Gearing gives the investor greater market exposure. It is designed to provide the investor with a greater profit on their investment. Gearing or leverage in hedge funds must be handled by a professional portfolio manager who understands the concept well. Intelligent gearing increases the profits to investors. If it is done poorly, gearing will increase losses to investors. What is private equity and real assets? Publicly listed companies like Naspers, Facebook, and British American Tobacco offer part ownership in the company through shares listed on the stock exchange. Private equity firms usually create a fund and use it to buy multiple businesses not listed on the stock exchange, like JSE, Nasdaq, and the S&P 500. The goal is to sell each of them at a profit by a certain time frame. Usually, this involves taking over poorly performing companies and replacing management teams, systems, and logistics to improve the business performance, with the aim of turning a troubled business into a consistently profitable organization. Private equity makes earnings through management fees and a share of company profits. Real assets get their value from themselves. Real assets would include a company factory, machinery, trucks and tractors, real estate, land, and so forth. They are great to include inside an investment portfolio because they are not correlated to financial assets like private equity and publicly listed companies. Commodities like wheat, gold, and oil are also real assets. A commodities futures contract is not. A futures contract is an agreement between a buyer and a seller agreeing to buy a certain amount of a commodity at a set price in the future. We will unpack futures contracts at a later stage.
The key takeaway for this part is hedge funds can be managed with more flexibility as their managers have an array of extraordinary investment strategies at their disposal to generate investment returns in uniquely diverse ways from what the market produces. So don't miss out on a world of unique flavors. Make wise financial decisions that your future self will thank you for, and order a hedge fund from the investment menu. Please join us for part 4 as we will do myth busting, talking to some of Fairtree's portfolio managers.